After a decade of UK underperformance, Vanguard is going global. The UK's most popular fund range is dialing back the domestic tilt and launching a purely market cap weighted alternative. Impeccable timing, or overdue housekeeping?
We look at what's changing, whether you need to do anything, and if home bias is actually a mistake. And in today's dumb question of the week, why are multi-asset funds limited to stocks and bonds? All right, let's get into it. So, Romin, I don't want to say that all your prayers have been answered, but one specific prayer seems to have been answered in the last week. Am I right?
Yeah, I was so excited. And they finally announced this after so many years where I was whinging about it. And then everyone else started whinging about it. Or maybe they were whinging before me, I don't know.
You were the trend-setting whinger.
That'll be my epitaph, yeah. But they finally reduced their UK overweight on life strategy funds. And people always say this in the same breath. Oh, life strategy, very good, very low fees, cross-asset funds, but the UK overweight. That was in every summary.
And these are really popular funds, aren't they? There's more than £50 billion in Vanguard's life strategy range. That's a lot of capital for the UK market.
And it's justified, I think, because they offer what people want, which is a very simple way of allocating in a diversified way and in a way which matches your risk appetite, almost any risk appetite, whether that's 20% equity up to 100% equity.
And so last week they announced a suite of changes, which I think we should just go through one by one. So the first change is unambiguously positive for investors, and that's cutting fees. We always like to see that.
Woohoo! Yeah, I was so excited about that too, because this is something they've been doing consistently. As the assets under management have expanded for their UK funds, they've been cutting fees, the ongoing charges figure.
So in this instance, they're reducing the fee from 0.22% down to 0.2%. And Vanguard says this will save investors more than £10 million in the aggregate.
And that's a mathematical certainty. We know that's true. You can't say much about return, but you can say what's going to happen with fees. So all praise to Vanguard for this. I love them for this change.
And is this just because there's competitive pressure on Vanguard now? Like people are doing to Vanguard what they did to everyone else, which was undercut them when it comes to cost.
Yeah, look, it's still true that you could produce your own life strategy funds for half the fee, even the cut fee, because you could just buy global equity and some kind of fixed income product and probably pay around 10 basis points. That's 0.1% for that. It wouldn't have all the whistles and bells of Vanguard's life strategy funds. They do tend to be quite diversified within each asset class, but I'm not convinced that that's going to have a massive difference on the return and the risk.
But it would involve rebalancing yourself, which is a bit of a hassle for some people.
And again, I think that's something which has changed recently. So, for example, if you're on one of these new platforms, such as Invest Engine or Trading 212, you can rebalance your portfolio with a single click. So I think that argument about the extra fee you pay for rebalancing really doesn't apply.
I wonder if Vanguard is getting lower bid-offer spreads than if you were doing it yourself, though, with that kind of one-click rebalancing.
Yeah, you could argue that they're doing it more cheaply or that they'll do it more efficiently, which is possible, but...
And they definitely won't forget to push the button, which you might.
Yeah, I mean, the automation is definitely a benefit. Now let's move on to the other headline-grabbing changes, which is what all the journalists have focused on, justifiably, I think. Now, the first of those is a reduced home bias, and this is what my complaint was, and what we've seen is that they're going to drop that from 25% to 20%, and that's for the equity allocation, and then for the bond allocation, they're moving from 35% to 20%. Now, I only had an issue with one of those UK biases, and that was on the equity allocation. I think for fixed income, there's actually a pretty good case to be made that you have a home bias, if not an outright gilt exposure.
Oh, interesting. Can you unpick that for us? Why would you not want a home bias in your stock allocation, but you might do when it comes to bonds?
Well, I think gilts are very safe. I think that's the primary reason. And if you do go for foreign denominated bonds, so let's say it was US Treasuries, then usually you have some kind of currency swap in order to hedge the currency risk. And then you pay away the interest rate differential anyway. So what's the point of that? I mean, it does give you a little bit of diversification in case your country goes bonkers and throws fiscal caution to the wind and starts issuing huge amounts of domestic government bonds.
But Life Strategy doesn't just have government bonds, does it?
Yeah, it's got investment grade stuff. It's got mortgage-backed securities in the US. So it's got these diversified global bond funds, which contain other asset classes as well within fixed income. But again, I think at the moment, there isn't much to be gained by getting credit exposure because credit spreads are so tight. Maybe over the long run, this is going to boost longer-term return. But you could always go for investment-grade UK corporate bonds as well. But I don't buy the bonds for return, I buy them for safety. And if you want inflation-linked exposure, well, why not get inflation-linked exposure using your country's domestic inflation index, which is what you get with index-linked gilts?
But it's interesting that a lot of the press reaction has focused on what they're changing when it comes to equities. So as you said, what was a 25% exposure to the UK is dropping to 20%. But really, the bigger change is in bonds, going from 35% to 20%. You've said you didn't particularly ask for that change, but do you have a problem with it?
I can certainly see a scenario in which that change will hurt UK investors, particularly given what's going on in the United States right now and its effect on fixed income. If it is the case that we have a populist US government which doesn't really care about fiscal caution, then there could be an accident in the Treasury bond market. And at the moment, it's looking more likely that would happen in the US than it would happen in the UK. Okay, the US Treasury market is vast in comparison with the UK one, but still, that doesn't mean that it'll always be without risks. They've got 120% debt to GDP, we've got under 100. They've got a big fiscal deficit, we don't. So I think from that point of view, I'd say that gilts are still in a pretty good place. So I think what they've done here is something that nobody asked for, which is to take away the UK bond overweight. I certainly wasn't asking for it.
No, I'm not sure many people were because everyone was so focused on equities. But what I do like is that they've brought the UK allocation into line for the equity and the bond components. I think that makes sense. It will be 20% for both. It's certainly easier to explain.
And the explanation was always about what customers wanted, in theory. But I never spoke to any customers who wanted that. Maybe it's just what was conventional at the time. Certainly looking at many people's workplace pension schemes, it's often the case in the UK that I see very large UK domestic biases for equity.
Well, let's look at what Vanguard has said now. So Ben Summers, the head of UK at Vanguard, said, over time, as UK investors have grown more confident investing internationally, Life Strategy has evolved to have a more global focus. And their rationale seems to focus on the fact that UK investor surveys have shown their preference for home bias declining over time, as well as the fact that the UK's share of global markets has actually shrunk since Life Strategy launched. So if they just kept the same 25% allocation to the UK for stocks, that would actually be increasing home bias over time in relative terms.
And I think that's the real problem, which is if you look at the performance of Life Strategy 100, say, versus a truly market cap weighted global index, it's had a huge underperformance over the last decade or so. And I think that's very difficult to justify given the underperformance. Now, I think the timing of this is perhaps unfortunate. If you look at what's been outperforming recently over the last year or so, the UK's been on fire.
Yeah, this is happening immediately after, like the 1 year where UK actually blows everything out of the water.
And look, all the conversation now is about divestment from US assets and is the US still a safe investment? All of these conversations are now what's being bandied around. So I think the timing, gosh, they got that badly wrong.
Well, we'll see. We don't know what the performance is going to be like in the future. Maybe the US will continue to outperform. But what I want to stress with these Life Strategy funds, even after these changes take effect and they're being phased in over the next few months, it will still have a pretty chunky UK overweight. So if you look at the equity component, the UK makes up around 3 to 3.5% of global equity markets, and Life Strategy is putting 20% of its money into UK stocks. So that's still a 6 or 7 times overweight for the UK stock market.
Yeah, and that's just for their existing life strategy funds. So just in case you wanted to go the whole hog and produce something which is truly market cap weighted on the equity side, they've got a new range. So now it's like classic Coke and new Coke.
Yeah, but in this case, New Coke might actually be better. So this is Life Strategy Global, which is the range they're launching here. And it's going to mirror the existing Life Strategy funds in the sense that it's 20% stocks or 40 or 60 or 80 or 100. But the difference being there is zero home bias in their global range of funds. And I guess what that actually allows an investor to do is if you wanted not a 20% allocation to UK, because that's a 6 times overweight, but you wanted 10%, you wanted a 3 times overweight or something, you could buy half the Life Strategy original Coke and half the new Coke, couldn't you?
You could. And I know some people who say, look, I don't want Life Strategy 60, I want Life Strategy 70. So I say, well, just buy Life Strategy 60 and 80 in equal weighting. I'm not sure why you'd want that amount of accuracy. I'm not sure that you'd actually be able to know that that's precisely what you wanted. 20% bands are good enough for me, but people do.
But now you can do that same thing, not just on the overall equity allocation, but on the overweight for the UK.
Yeah, so we've got a whole new dimension to fiddle with, which I think is a problem because the whole point of Life Strategy was that you could just buy one fund and it would be diversified, it would match your risk appetite. And for most people, that would get them to where they need to be in terms of their financial goals.
That's still true. I don't have a problem with that. I like to offer more choice to people. It's not like there's a ridiculous choice. It's just, do you want the UK overweight or not? And what's your stock bond split? You know, if you're limiting yourself to Life Strategy.
Yeah, they have been doing this recently. I've noticed that. They have been offering funds which are much better in terms of giving people choices. The really big change, I think, which was hugely beneficial, was having income and accumulation versions of all of their funds on their website. And as a tool to explain the difference between income and accumulation, I think it's great because you can say, look, here's exactly the same fund. Either it's an income fund or it's an accumulation fund. And look at the returns. Oh, look, the accumulation one's increasing faster over time. That's because the income's reinvested. But it's exactly the same stuff in the fund. So it's a really useful teaching tool. And of course, we've seen a new short duration UK gilt fund. That's something that they should have done long ago. So they are innovating all the time with new offers on their range of funds. Maybe not as quickly as some people would like, and there are still some huge gaps in terms of what they offer.
Have you got a wish list written on the back of your hand now?
Yes, indeed. So, so one of the things, right, is high yield corporate bonds. They don't offer that because the argument might be you don't really need it. You could just have more equity in your portfolio because high yield corporate bonds are a bit equity-like. But I think for people who like income, that's removing one really nice source of income over the long term. And if it's globally diversified, I'm not convinced that it would be hugely risky. I mean, if you're going to buy equity in emerging markets, which is one of the funds they offer, then I'd guess you'd be happy with high yield corporate bonds. Another huge gap is in commodities. So they don't offer a broad commodity exposure fund. They don't offer a gold fund. Now, there are reasons for that. Certainly, if you go back to Jack Bogle, he hated gold as an investment because it was a wasting asset. It didn't offer an income. He thought of it as pure speculation. But certainly, if you are empirically oriented, which we are, Michael, then a lot of the conversations we've had show that gold actually helps as part of the portfolio mix over the long term.
No doubt they'll launch a gold fund right at the top of the market. I've seen it's gone through $5,000 an ounce, I think yesterday or something.
Yeah, it's still on its way up. And of course, the reason why it's going up is still in office. So that's probably why.
I suppose it's too much to be asking them to launch any sort of crypto products.
That will never happen. I just can't see that happening. I mean, that probably not in my lifetime. Jack Bogle will come back and throttle Ben Summers if that happens.
Yeah, Jack Bogle would be rolling in his grave. And that is not the kind of rotation we want in our portfolios.
Oh, very good.
But how do you think these changes around life strategy are going to be received now? So I think for most investors, it's probably a shrug. if you hold a life strategy fund, it's just going to change a little bit under the surface. Still going to have a big UK overweight, it's going to be less so. But I think politically, it could be quite controversial because we know the UK government has been pushing again and again to get more assets invested in the UK. They've focused a lot on pension funds. And I presume a lot of life strategy is held in SIPs.
And remember that Vanguard is one of the managers, the asset managers, who's part of that initiative in collaboration with the UK government. So I suspect Rachel Reeves may not have been too happy about this change.
Vanguard, of course, says it remains committed to the UK and optimistic about its future.
It was certainly a huge relief when Rachel Reeves didn't announce that they were going to force UK investors to buy UK assets as part of the SIP and the ISA. And really, it's down to a philosophical difference between people. In one camp, you've got people like me who think that actually the reason for the ISA and the SIP is to encourage people to save for the long term so the state isn't on the hook for them at the end of their lives. And then on the other side, you've got people who, incorrectly of course, think that this is going to boost the UK economy. If somehow UK investors buy more UK assets, that's going to provide capital and kickstart the UK economy.
Yeah, it would take a massive movement of capital for it to do that. There is a tenuous path where it can happen, whereby more people pile into the UK markets, it boosts our stock prices and our valuations, which therefore tempt more companies to list in the UK. And that sort of gets a positive feedback loop growing, and we eke out a little bit of growth. But it seems that that is so far down the list of things that's going to get the UK economy growing. There's a lot of low-hanging fruit in terms of regulation to go after.
And also the size of the market. If you've got the UK, well, we've decided through Brexit to limit our market and make it much more difficult to export to Europe. There are many more trade frictions because of that choice. And also for investors investing in the UK from abroad, well, now they're just investing primarily in us as a domestic market, which is much smaller.
And yet, despite all that, the UK market did really well last year. It beat the S&P 500. It outperformed global markets. Is the danger here that Vanguard will be accused of chasing returns over the long term? So they've seen, a decade plus of underperformance of the UK market. And it's a significant underperformance. So the UK stock market's gone from something like 8% of global market cap in 2008 to more like 3% today. Over the last 10 years, the FTSE 100 is delivering something like 6% annual total returns, which is a couple of percentage points less than Europe, and around half of the growth delivered by the S&P 500. So it's been a dreadful decade. Are you surprised it's taken Vanguard this long to reconsider its UK exposure?
Well, kind of, yeah, because it hasn't just been a bad decade, it's been a bad century. If you go back 100 years, you'll see that we were actually a quarter of global markets then. There's a reason why we've gone into this state of decline. It was funny because I was trying to convince AI over the weekend. I mean, in theory, it's just supposed to do your research, right? But I was trying to convince it that the UK had a really strong case for investment. Because I was thinking this would make a great video, how the UK primarily is a service-driven economy. And if we were to use AI more efficiently, then it could massively impact positively on the bottom line for service companies. And it was just not having it.
Yeah, the AI just kept going, we have the highest electricity prices in the world. You're not going to succeed.
It kept shooting me down. So it's interesting, right? Which is that in theory, it should be a search tool or at least a kind of thinking tool, but it's got very strong biases, or maybe it's right.
But to just come back to the question of whether Vanguard should have done this change earlier, well, maybe not. As we said at the top, they're the most successful fund range, multi-asset fund range in the UK. They've gathered a lot of assets, so they've been doing something right. A lot of people have put them in their portfolios.
But it's a bit like Shake Shack Vanguard. They always have a very restricted range of products, and that actually makes it easier for their customers. I think if you've got too much choice, people just get scared, particularly as it's a DIY platform.
What was that analogy you used? Vanguard's a bit like Shake Shack, did you say? I did not expect this analogy. What are you trying to say there?
I just heard this interview once with the guy who's founded Shake Shack, and he said that was their secret of success, which is they offer a restricted menu and they just do a few things well.
And we should say that this episode is neither sponsored by Vanguard nor Shake Shack.
But we are open to offers.
But to step back from Vanguard and life strategy and just talk more generally, when it comes to equities, are we sure there's not a case for some home bias in a portfolio? We've spoken to Tyler before from Portfolio Charts, and he's convinced, based on his back tests, that if you overweight your domestic market a little bit when it comes to stocks, that helps things like the safe withdrawal rate, because the domestic stock market is more likely to accurately track local inflation. That's the case he makes. And I have seen the same case made by investment professionals and some academics.
Yeah, and I can see a world in which the UK would outperform because of its sector composition. If it is the case that tech isn't so hot in the next decade, that it's about commodities, or maybe it's about UK banking, or perhaps there is some kind of renaissance in growth in the UK. Well, yeah, we could see the UK's weird sector composition with no tech at all and lots of miners do very well. But you see, from my point of view, I always think of that as increasing the risk, simply because if you consider countries where their domestic stock market completely went down the pan, which has happened repeatedly in history, either because there was a change in government and they actually scrapped capitalism altogether, I'm thinking of China, Russia, or because they just completely screwed up their economy. So countries like Italy, which has just been struggling for a very long time now in terms of equity market performance.
The counter-argument there is that there are other risks in owning overseas stocks that are not present when you own equity in a company headquartered locally. I saw Ben Felix did a very good video where he made the case for domestic overweight. And he looked back through history and he said, when it comes to times of geopolitical unrest and war, inevitably, foreign investors are treated worse than domestic investors. You might be expropriated, you might be forced to take a haircut. And yes, these are tail risks, but it's kind of the flip side of what you were saying. Whereas your home market might go down the pan. Well, yeah, but you also might get treated really badly and discriminated against because you're a foreign investor in bad times.
Well, I take it another way, which is to say that if you're in a country where you've got a very strong safe haven currency, yeah, I think there's a very strong case to be made that in extremis, you'd be probably better off to keep your assets domestic or at least have that domestic bias. In the UK, though, the situation we find ourselves in is that if there is a global crisis and a pullback in risk appetite, usually it's sterling that sells off. And that means that if we do have other investments elsewhere, assuming they're not expropriated or there aren't capital controls imposed, then that flatters those foreign investments in sterling terms. That's certainly been the case until recently, when the dollar's been selling off during these crises because the centre of the crisis has been the US. Now, maybe that's a new normal, maybe it's not, but I think that that's another thing to consider, which is the non-safe haven status of sterling. And that makes a big difference depending on whether you should have a domestic bias or not, whether your domestic currency is a safe haven.
Basically, what we're doing here is arguing about which tail risk do you fear more, being treated badly by other countries or your own country just going down the pan. Either way, you don't want all your money in one market. If you're going to do an overweight to a domestic market, it should be a small one. But even outside of tail risks, some people make the case that what you're really trying to do with a portfolio is to match or beat inflation. So you can live off it. That's the goal. And it does seem to be the case that domestic stocks will protect you better in a bout of localized, unexpectedly high inflation. Because inflation is not the same everywhere around the world at all times.
Yeah, the inflation aspect of it is an important one. Certainly, if you look at a country like Turkey, the reason why it had incredible returns for a period of time was because people were investing in their domestic stocks, because that was the only way to protect the value of their money. If you put it into a bank account, it was basically just ticking down in value on a daily basis. So there is an argument to be made for that, I think. But I guess, again, the question is, what's your country's history of inflation like, and what's it likely to be in the future? And certainly in the UK, we've done a pretty good job of keeping inflation under control. Certainly not in the 70s, but since then, it's been a lot better than it has been. And of course, we've still got our own independent central bank, unlike some other countries, which may not have them for much longer.
So it sounds like, from the point of view of a UK investor, you don't really think there's a case for a domestic overweight when it comes to stocks.
Only in as much as UK equity is currently cheap. It's still, I'd say, interesting on that basis. It has that high income property, which many investors like. Again, I don't like that, but many investors do. But other than that, I don't think there's a strong case to be made in all countries for having a domestic bias. And I think the UK is one of the countries where I'm not convinced that it's going to be a benefit to someone. Now, having said that, yes, I do have a UK overweight, and it's because of those reasons, primarily to do with undervaluation.
I guess if you're a contrarian investor, Vanguard finally adjusting down the home bias in its life strategy funds could be an indicator. I mean, it shouldn't be. The UK's been fighting the flows for a long time, but you'd think the tide would have to change at some point. Maybe that was last year. Maybe that was the start of the change.
Maybe, but I still see specific reasons why that happened then. Is it going to continue? Possibly. Certainly if tech underperforms in future, I think that'll be a good story for the UK. And if we see the commodity surge continue, well, yeah, that's going to be good for the UK as well. But if energy prices surge, well, that's not such a good story for the UK at all.
The thing is, if you stick to pure global allocation, market cap weighted, you are very concentrated in the US right now. More than 60% of your money is in the US stock market. And that market is highly concentrated in the big technology companies. We've spoken before about how people are nervous about that and are thinking of tilting away from that, dialing the US down a bit from 65%. I suppose life strategy is kind of one way of doing that. It has been by default, right? Because it's overweight the UK and therefore everything else, including the US, is underweight a little bit.
But again, it's really easy to do it yourself. You just need 3 funds. So you take a US fund, you take developed ex-US and emerging markets. And if you wanted market cap weighting, it would be 65 US, 25 developed ex-US, 10 emerging markets. And then just jiffle accordingly based on your views. And you can do that very cheaply. That'll cost you something like 12 basis points, something like that. So again, if you are going to go down this route of adjusting things, I think it's very easy nowadays to do it yourself. All it takes is that little step of knowledge to learn what it is you need to do in order to do it yourself. Not everybody's comfortable with that though. So look, if you're talking to your aunt or your parents about investment, maybe you'd suggest something like life strategy. Because it's simpler. If they haven't invested the time to learn about investing, I think it's a good one-stop shop.
Okay, just to wrap up, let's focus on a couple of specific scenarios that investors might face and the thought process they should potentially go through. Imagine you're an investor now and you have 100% of your money in Life Strategy 60 or Life Strategy 80. You've been comfortable with that. But now Vanguard has launched this Life Strategy Global range. Your UK tilt is going to come down anyway if you do nothing, but you could completely eradicate it by buying one of these new funds. Should that person be tempted to make the switch?
I think many new people who are just getting into investing probably will. I think people who've got existing funds, who've done okay with Life Strategy 60 or whatever, I think for those people, the inertia effect is probably going to stop them switching. You're happy with what you've got. You can't be bothered to switch. Who knows? The new thing might be worse. But I think new investors will probably opt for something which is globally diversified, more along the lines of market cap. And that's because they'll probably look at back tests. They'll look at the comparisons and they'll see that if you had gone for something which was market cap weighted, it would have done much better historically until this year.
Okay, a second scenario that a lot of UK investors might face now. I know that many people hold as the core of their portfolio Vanguard's FTSE Global All Cap Index Fund, which is basically a market cap weighted global stock index tracker. It has more than 7,000 holdings. but the ongoing charge is 0.23%. If they're locked into the Vanguard universe, should they be tempted to buy the Vanguard Life Strategy Global 100, which is, again, a passive global index fund, market cap weighted, but with a lower fee, 0.2% versus 0.23 for the global all cap?
Well, I switched from the global all cap to, actually it was the developed version of their global fund, so doesn't include EM. And that's because of the lower fee, the 0.12% fee. So if they are very fee sensitive, I'd consider it, certainly.
But there is a difference between the funds, right? You're not comparing like for like necessarily, because the FTSE Global All Cap has small companies in the index as well.
Yeah, and again, small caps have been doing very well over the last 6 months. And over the long term, small caps have tended to do well. So, that's probably why they bought the global all cap in the first place, to get a bit more exposure to that and hopefully a bit of outperformance. Would the outperformance exceed the fee saving if they switched to Life Strategy 100? Maybe. Who knows? But I'm guessing they bought global all cap because they wanted that small cap exposure, so they probably wouldn't switch.
I'm guessing most people didn't buy it consciously because they wanted small cap exposure. I'm guessing they bought it because they saw other people had bought it and it's a global fund, it's passive, it's relatively cheap. And I think that gets to the heart of all of this, which is that I reckon most people who invest in Vanguard funds probably couldn't describe in detail what they hold. They could just say roughly, I hold global stocks, it's passive, it's cheap. But I don't think they could probably tell you exactly the breakdown of what's in the UK market, how much of an overweight that is. Do I hold small caps? Are my bonds currency hedged? I reckon most people don't know that stuff. And you could say that the good thing about Vanguard is they probably don't have to worry about it too much.
Yeah, it is a soft play area in terms of the funds that it offers. It's really difficult to hurt yourself on Vanguard. And any of those choices would be reasonably good and probably quite similar in terms of return. But there are alternatives to these life strategy funds. For example, if you look at BlackRock's range, it's got the MyMap funds, which are based on risk exposure. So how much risk are you willing to tolerate? And that's defined in terms of volatility.
And they have not suffered from the same UK overweight that Life Strategy has.
Yeah, that's right. And that's why they've outperformed. And their fees are often lower. So I think Vanguard's had to react to that. But look, if I was going to give feedback to Vanguard about this, and apparently they do listen to our stuff, but if I had to say something, it would be well done. I think the fee cut is brilliant. I think offering more choice for your clients is good. As long as it doesn't get crazy, I don't think that you should offer thousands of new funds. Keep the platform simple, but that is an improvement, I think. Dropping the UK overweight, I think, is an improvement. The fixed income, not so much. But this just goes to confirm what I've always thought, which is that Vanguard is very good in terms of aligning its interests with those of its customers. And when it says that it wants the best outcome for its customers, I get the feeling they mean it.
I agree. And any feedback for Shake Shack before we go?
Now, I think our philosophy at PensionCraft is very similar to that of Vanguard. We do want the best outcome for our members. And if you wanted to join the membership, it's really easy to do. Just go to our website, pensioncraft.com/membership to learn more.
Okay, today's dumb question of the week. Why are multi-asset funds typically limited to stocks and bonds?
Now, I'm glad you used the word typically there, Michael, because it's not always true, but it's generally true. And I think part of the reason is to do with the reason why Vanguard had the UK overweight, which is that it's easier to market these products to customers because it's not controversial. If you've got a fairly vanilla mix of stocks and bonds, well, that's kind of what people would have bought historically anyway. If you start introducing weird asset classes into the mix, then it's always a risk because asset classes blow up, they crash, and you have to justify including them. Now, of course, that's also true with bonds. We've seen that recently, and they've caused a big drag in return due to the crash in 22-23. But it's better to fail conventionally in finance than to fail unconventionally.
I suppose also that most of these funds we're talking about are open-ended and designed to be highly liquid. Therefore, the assets you want in the fund should be highly liquid, with a known price always, and easy to sell. So you couldn't really introduce things like private credit or infrastructure, or you get into trouble. But I'm less clear why we don't have versions of something like Life Strategy that also has 20% in gold, for instance.
Yeah, because gold is a very liquid market, so you could sell even in a crisis. I think that does really just come down to the philosophies of Jack Bogle. But also, I think it's true that gold is itself a crashy asset class. So if you're in a situation where gold crashes, which we may well find ourselves in soon, then, well, if you're sitting out a huge bear market in gold, it's going to look pretty painful having that allocation as part of your portfolio.
I think the main point, though, is simplicity, which you said. For most people coming to an investment platform, it's confusing, and they just want one lever to pull to dial up or down risk. And typically that is the weighting between stocks and bonds. If you're adding in a third dimension of gold, or multiple dimensions because we're adding in commodities and we're allowing people to tweak domestic and overseas holdings and all of that stuff, well, then you're into really detailed asset allocation, which has its place, but not for most people.
Yeah, I think that's fair. Most people aren't aware that you could classify assets into risky and safe. And within those categories, you could probably have a lot of different variations. And they don't want that complexity. They just want a black box thing, which is very simple on the face of it, where you've got a big lever which says risk, which is either high or low. They don't want the nuance.
I do wonder, though, with how well gold has performed in the last couple of years, whether we will see in the UK one of these big asset managers take a punt and launch something which combines stocks, bonds and gold as a multi-asset fund. Because I think it might do well. People might buy that. I'm not saying the performance will be great necessarily, because we might be at the top of a bull market in gold. Typically products launch at the moment they shouldn't launch, right?
It's interesting. If you look at the fund prospectus for the MyMap funds, these are the ones which are managed by BlackRock. It actually says that it may also invest directly in financial derivative instruments to gain exposure to alternatives like precious metals. And it may hold up to 15% of the fund's net asset value indirectly in alternative asset classes. So presumably a 15% gold allocation could happen.
But they don't really make a song and dance about it. And it's dynamically allocated.
Yeah, maybe at the moment they would make more of a song and dance about it because the marketing department sees the value of saying, oh, look, it's got gold in it, and that's been doing really well. But usually at the end of one of these coaching calls with my clients, they often say, is there anything I've missed? Is there any asset class which I should have included? And I always say the same thing, which is no, you don't absolutely have to have these weird asset classes. You don't have to have private equity, private credit, or infrastructure. Stocks and bonds historically have got many people to where they need to be, and I think that'll be true in the future as well.
Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.